Let's begin then. What are real interest rates? Something that very few traders understand at a practical level, but pretty much everyone seems to understand it at a theory level. So I'm not going to spend too much time talking about the theory. Rather, we're going to get the charts up and look at what it means at a practical level. That way you can implement it into your trading immediately. Now, what you've got up in front of you is a real rate. What is a real rate? It's simply just the nominal rate minus inflation. Now, there's a number of ways you can do this. If you want to look at a slightly more lagging real rate, you could effectively take the current interest rate of the Fed. So you could say, well, the current rate is 4.5%. You could then take the Fed's preferred inflation gauge, which is PCE. You could minus the 2.3%. And you could say, well, currently speaking, the Fed or the US has got a real rate of around 2.2%. Now, of course, it's lagging. Why? Well, because we know that the PCE rate is looking at the year-over-year rate over the course of the last 12 months. So we don't really want to be looking at that. And we could, of course, then also consider the real rate to say, well, at the end of the day, 4.5% is what the current base rate is from the Fed, but they're going to cut. They're expecting to cut, of course, next week and again 4 times next year. So this is very much a lagging type real rate. For me, I prefer to look at a more forward-looking dynamic real rate, where I look at simply just what is the interest rate 12 months from now. Okay, so rather than looking at today's interest rate, I look at 12 months, where will interest rate be? And then I also look at what's the market's expectations of inflation 1 year from now. Okay, so I prefer to lean on something that's a little bit more dynamic, and that's in essence what you are seeing in the chart in front of you. Now, for the Tradelo traders, of course, you have got access to the Metastock discount. You can, of course, go and get that 1 month and pay for 1 month and get 3 months access, and you can simply go and load this chart. There is the ratio or the codes for you. Okay, now. That's the theory of it. It's ultimately real rates is nominal rates minus some form of inflation. Now, in a moment, we're going to talk about how real rates impact different markets. But another way you can look at this, and I'm going to come back to this in a moment, another way you can look at this is to go and break out the two variables. So what you can see here in the green is we've got the current Fed's interest rate, okay? And in the blue, we've got inflation expectations, okay? Now, when you put the two lines, you can suddenly start to see those gaps or those spreads developing. And in essence, that then showcases to you when we've got positive real rates as well as negative real rates, as well as the degree. Okay, two different ways you can look at it. In essence, they're both showing you the same thing. Okay, now, what's the theory? Let's discuss the theory. Let's come back to this chart. Let's talk theory. In a very, very simple sense, higher interest rates, higher real interest rates, ultimately are very attractive for owning bonds and for putting your money in the bank. Okay, because at the end of the day, you are being rewarded for saving your money with a high real rate. Okay, and that's, in other words, the yield or the return you're getting on owning a bond is very, very high, and it's very relatively low risk. Okay, so in a high real interest rate environment, you typically want to own bonds. Okay, if the Fed said to me, look, Mr. Barrett will give you 5% to own our bonds. I'm looking at that going, saying, well, after inflation, I'm earning 5%. That's really attractive. And what can I earn, or where can I invest my money elsewhere that's going to get me a better return than that? Okay, so in a high yield environment, or a high real rate environment, sorry, we want to own bonds. And obviously, in a low real rate environment, we don't want to own bonds. Okay, because effectively, if we're not getting any return for giving our money to the US government, ultimately we'd far rather go invest in something that is giving us some form of a return. Okay, so that's how it impacts bonds. And I'll show you a couple of charts in a moment just to really kind of drive home the playbook on this. But first, let's just cover the theory. In terms of equity markets, how does the real rate impact the equity markets? Well, the real rate is ultimately the discount rate. In other words, when we look at effectively what sort of discount rate to use, or at least what the value of our future cash flows might look like when investing in the stock market, we use the real rate as the discount rate. Okay, so when we have high real rates, ultimately the discount rate increases, and that reduces the present value of our future earnings. Okay, in other words, high real rates, are making equities less attractive to own. And obviously the converse is true. When we have low or negative real rates, it makes owning equities more attractive. Okay, so again, that's for equity markets. And then for currency markets, again, yeah, what we have to do, because we're comparing two different countries or two different currencies, we ultimately have to look at the real rates of one country versus the real rates of the other. And in a minute, I'm going to show you the example of the Japanese yen. If we look at the US right now, currently they've got real rates around 1.2%. In Japan, we've currently got negative real rates of around 1.5%. Okay, so it's very attractive owning United States dollars over owning Japanese yen. We'll talk a little bit about how that really impacts the currency markets and ultimately how you apply it if you are trading currency markets in general. Okay. So that's the baseline. And then, of course, gold. A lot of us like to trade gold. Gold's quite a simple one in essence that gold doesn't give any form of yield. Okay, so we always typically want to own bonds over gold when there is some form of a real yield. And of course, when there's no real yield, we'd prefer to hold gold, particularly in times where we need some form of a hedge because of perhaps a weaker dollar or some form of risk off type sentiment. Okay, so that's the baseline. Real rates ultimately, high real rates have an impact on markets, low real rates have an impact on markets. Now, the reason why so few people understand or ever look at real rates or comment on real rates is because typically it's not something that should be moving around much. Why? Well, because what's the Fed's job? Let's think about this. And before we get to the charts, it's important you understand this. The Fed's job ultimately is to keep real rates somewhere around 50 to 100 basis points. Okay? Why? Well, because that's the level at which they're not accommodating the economy, but they're not restricting the economy. Okay? So by definition, real rates should not be moving. And the only time they move is when the Fed's not doing their job. For example, go to late 2018. What happened? Well, the Fed, of course, over tightened. They did a bit too much quantitative tightening. And as a result of that, real rates went spiking up the page. Okay, they suddenly had to intervene. And that's when we had the first ever flip-flop pivot from Powell in late 2018. Okay, the result, they began the process of cutting interest rates in July of 2019. Okay, if we then fast forward to 2020, we all know what happened there. We had COVID, and COVID, of course, central banks set rates back towards the zero bound, and as the result, real rates collapsed. Okay, and then likewise, they fell behind the curve. They kept a stimulative type policy in place for far too long. The result was inflation starting to rally, or inflation expectations started to rally. And of course, those real rates eventually played catch up as all central banks hiked a lot more aggressively than anyone expected. Okay? And if I show it to you on this chart, you'll see a little bit more clearly. Again, what we can see from the period 15 all the way to 18, relative stability. All of a sudden, we had the flip-flop, and that's where you can see a really significant gap opening up between where interest rates were and inflation expectations. And then likewise, when you move into 2020, same thing. They were too slow to respond post-COVID. Inflation expectations rallied. Interest rates were too slow. And then obviously now we're seeing the opposite of that. Okay, in other words, the reason we're actually seeing real rates move up and down at the moment is because central banks are being forced to take policy measures that are a little bit less traditional than normal. Okay, in other words, they're either falling behind the curve or they're doing too much. And as a result, real rates are moving up and down quite aggressively. Okay, now why does that matter? Well, let's get on to the charts. So we spoke about equities. The relationship holds true. When there's high real rates, we should see equities underperform. Okay, you don't want to own equities in a high real rate environment, and the opposite, of course, is true. Is that always the case on the chart? And this is what's key to understanding. The theory says one thing, which is in a high real rate environment, don't own equities. That's the theory. That's the general playbook. But real rates, of course, must always be taken in to account with what other markets are doing. In other words, you don't want to hold equities in a real rate environment where the real rate is actually high enough to justify you not holding equities. Okay, how do I explain that as an example? Well, if real rates today, okay, right, currently you can see they're around 1.2%, but if real rates were 10%, no one would own equities today, everyone would own US bonds. Okay, now I know that's a bit of a crazy example, but that's how you have to understand it. It's a lever, and when those real rates are justifying investing in them, in other words, they're high enough for people to invest, they'll no longer take the risk of holding equities over bonds. Okay, they'll move out of equities and move that money into bonds. Okay, and that's important to understand because the question hopefully you'll all have by the time I'm done with this chart is, well, Brannigan, if real rates are sitting at 1.2% and that's supposed to be restrictive, why are equities at record highs? Okay. And that is the $1 million question you should hopefully be answering for yourself, or at least you will be able to answer when we get to the end of topic one. Okay. Now, again, I'm just going to go through a little bit of history so you can see how this, real rate scenario plays out. But we can see, again, 2018, the Fed over-tightened, real rates spiked. The result was equities underperformed. Okay, we had a little bit of a bear market correction, and that's when, of course, the Fed did come out and pivot. They then said, look, we're going to begin the process of cutting. Real rates then normalized back towards more normal levels. The result, equities then staged a rally. Okay, we of course had COVID. That created a whole bunch of risk off, but the result was they took interest rates or real rates very, very negative to stimulate, to provide liquidity, and equity staged a rally. They then said, look, hey, we need to hike rates. We're behind the curve. What did they do? Real rates rallied very aggressively. Equities underperformed. Okay, so the relationship holds very, very true for equities. High real rates are problematic for the equity market. So why then, if we are sitting at 1.2%, which is supposed to be restrictive, why are equities rallying? Okay. Now, let's talk briefly about what the Fed should be doing. The Fed should be keeping this real rate somewhere between 50 and 100. That's what they believe to be the level, to be sufficient that it's not accommodative, but it's not restrictive. In other words, if they are somewhere between this green line and there, somewhere around there, they believe that's the neutral rate. That's the rate where they're not accommodating, they're not restricting. So in their minds, they believe currently they are still restrictive, which is why they are signaling they're going to cut next week, as well as they're going to continue cutting next year. Okay, they believe that it's still sufficiently restrictive. Now, if that was the case, if they were sufficiently restrictive, equities should not necessarily be selling off, but they shouldn't be rallying into record highs. Okay, in other words, equity markets are telling the Fed, they're telling us that rates are not problematic and investors don't mind investing in higher risk, even with a higher discount rate. Okay, and that's how you have to look at this. Investors are very clearly very comfortable taking additional risk despite the fact that we still have real rates around 1.2%. Okay, now apply that same logic to the next chart, which is real rates and gold. Remember, gold yields nothing. Okay, so gold is a very straightforward relationship with real rates. High real rates, I'd far rather own US bonds over gold, so I'll sell the gold and buy the bonds. Okay, when real rates are very low and there's a fear of inflation, I'd far rather own gold as a hedge against that inflation until such a time that they put real rates up. Okay, same thing. We go to 2018, we can see real rates spiked and gold had an 18% drop. Okay, they then began the process of cutting and gold staged a very nice 30% rally. Okay, COVID hit, that created a whole bunch of shenanigans, but the baseline was real rates went very, very negative and gold went up towards record highs. Okay, we then had a period where, of course, gold moved mostly sideways. The Fed then began the process of moving those real rates very quickly back up into restrictive territory. Gold didn't like it. It suffered a 21% setback. We then peaked. Gold then rallied 24%. Now, same question. If real rates are supposed to be sufficiently high enough, in other words, the Fed still thinks we're restrictive at 1.2%, why is gold just 3-4% off record highs? Okay, that's not the right kind of relationship we should be seeing. Okay, in a time where we are still restrictive, gold should not be rallying. We should not be having one of the best years we've had in many, many years. Okay, we're up 29% year to date. And that's at a time when, if you start the year, we were sitting around 2.6% real rates. Okay, so real rates are substantially lower on the year, and that's why gold has rallied. In other words, the gold market is telling us they would far rather own gold as a hedge than owning the bonds, even though bonds are offering a real yield. Why? Well, because gold is telling us that investors do not believe that real rates are high enough to justify them owning the bonds over the gold. Moreover, they think real rates are not high enough to bring that current inflation rate back to the Fed's 2% target. That's what gold is telling us, that real rates are not yet sufficiently high enough. Okay? But the relationship still holds true. High real yields or sufficiently high real yields are bad for gold, and likewise, low or negative real yields is good for gold. Now, let's take that same logic and talk about Japanese yen or currencies in general. Okay, now this is where you have to be a little bit more dynamic. You need to see the real rate of two countries against one another. So you need to look at Japan, which roughly speaking has got real rates of around 150 basis points or 1.5%, whereas the US currently has positive rates of around 1.2%. 2% positive. Okay. Now, in this instance, okay, in this instance, you can see that there is a very big differential of around 2.7%. In other words, if I invest in the US, I get 2.7% more investing in US bonds over investing in Japanese bonds. Okay, so it makes absolute sense that I would want to own US bonds over owning Japanese bonds. Now, that's a very straightforward way to look at it. Of course, no one owns Japanese bonds other than the government itself. So we can't, it's not really the cleanest example, but it just remains true. As a result of that differential, the dollar will significantly outperform the Japanese yen over the medium term horizon. Okay, now as that spread between the two widens, in other words, it goes higher, it means that the US dollar will rally relative to the yen. And of course, if those real yields or that spread between the real yields narrows, that differential narrows, of course, that would mean investors would far rather buy back Japanese yen and sell the United States dollar. Okay. Now, again, you can see that relationship, and this is why the spread matters, not the actual number itself, because we can see that from 2017 all the way to 2020, we can see the Japanese yen typically strengthened or at least held on to some strength over the course of those years. Why? Well, because the differential wasn't significant enough to either own the yen or the dollar. Okay, it was only when we moved into the COVID era where what had happened? Well, of course, the Fed said we need to hike into very restrictive levels. We need to get interest rates up quickly. We need to hike 75 basis points to get real rates up. What did Japan do at the same time? Absolutely nothing. Okay. In fact, to date, they've done absolutely nothing. They are still sitting with interest rates basically at the zero bound, and they're not expected to move interest rates anytime soon. In other words, that differential widened very significantly, and that's why the Japanese yen rallied 30% over a course of, 3 quarters, basically. That's why, of course, since start of 2023, again, we had another 24% rally in the dollar against the Japanese yen. Okay, simply the market is saying that Japan, your real yields are not high enough. We want to sell your currency and rather own the United States dollar. Okay, so differentials is what matters ultimately when it comes to the equity markets. Now, let's take a look at one more chart just so I can really kind of throw a bit of a spanner in the works. What you've got in front of you now is looking at effectively inflation break-evens and 10-year bonds. In other words, in the orange, we've got US 10-year bonds, 4.2%. Okay, that's what the government pays you for owning its bonds. At the same time now, we've got the market's expectation of inflation 10 years from now. In other words, if you take the 4.2 and you minus the 2.3, you're looking somewhere around a real yield of 1.8%. In other words, that is what the United States government is giving you as an investable return for owning US 10-year bonds. Now, you have to ask yourself, given the current situation of a Fed that is not keeping rates at current level, but rather cutting, in other words, stimulating, as well as a Federal Reserve, or as well as a Treasury that wants to spend more money, okay, you have to ask yourself, is 1.8% enough of a return to be offering investors for them to own your bonds? And the short answer is the market doesn't seem to think so. And how is that confirmed? Well, we should not be seeing yields rallying at a time when a central bank is cutting. Okay, if you go look at every single cutting cycle, you will notice that when a central bank cuts, yields should move lower, not higher. Okay. Now, I suspect what you're going to see over the course of next year, you're going to see real yields become an important theme for market participants, where they say, well, hang on a sec, we don't want to accept owning US 10-year bonds at 1.8, and that's why we'll get the sell-off. That's why yields will need to rise to find an acceptable yield where investors suddenly start saying, okay, fine, we'd rather own US bonds now as opposed to owning other risk assets. Okay. And if you go and look at that, if you go and look at the spread and say to yourself, okay, if we compare these two lines and we look at this period from 2011 all the way to 2018, we can see there was a very narrow spread. In other words, investors were not being rewarded for owning US bonds. Effectively, in some instances, they were accepting no yield or even negative returns. What did equities do during that time? Well, they only went up. Why? Because why would you give your money to the United States government when you're losing money? That makes no sense. In other words, because there was no return on bonds, risk assets massively outperformed in that era. Okay, fast forward, if you go to 2020, what happened? Well, inflation went up the page. In other words, now there was an even bigger negative yield. You were losing substantial amounts of money. Why would you own bonds? And that's why everyone wants equities. Okay, likewise, eventually the Fed said, well, we need to hike rates. We need to offer investors more money to hold our bonds. What happened to equities? Well, then they had a little bit of a collapse, a little bit of a correction. Why? Because now it makes sense to own US bonds. Now, here's the million-dollar question. Right now, you can see that this is probably the highest yield, or at least the highest real yield that we've had in a 10-year bond since, of course, pre-2008. Okay, 2% is a very high spread or a very high real rate 10 years out. Yet why are equities rallying if this is one of the highest 10-year real yields we've had? Okay, and again, the question comes down to investors are clearly not sufficiently rewarded for owning US bonds at the moment. Okay, that's the signal the market's telling us. If they were being sufficiently rewarded, if this was a good time to own bonds because of the return, equities would not be rallying, they'd be selling off. Okay, so there's a lot of clues coming from the real rates, and that's why I wanted to address this topic today. It's very, very important you understand how real rates act on different assets. It's not just a case of high real rates are problematic. It's a case of when high rates are at a specific level, there will, of course, be spin-on implications.